Good morning, everyone. Good evening, wherever you are in the world right now. I'm Sébastien Bétarmier. I'm an associate professor of finance at the Desautels Faculty of Management at McGill University. It is my pleasure to introduce this third speaker series of our MIPC 2020. I want to welcome Adam McConkey from Volantis and Lombard Odier for taking the time to speak to us about investing in small caps in the UK. One of the theme of this year's edition of the MIPC, how can a large sovereign fund invest in the UK at this moment in time? I also want to introduce Deborah Ackery. Deborah will moderate this debate. Deborah is a student at McGill at Desautels. Deborah is pursuing her bachelor's in commerce with a major in finance and a concentration in international management. Deborah, the floor is yours.
Thank you very much, Professor. So hello, everyone, and thank you for joining us today for another speaker session. So today we're welcoming Adam McConkey from Lombard Odier, who's joining us directly from the UK. Adam is head of Volantis, UK small and microcap investments at Lombard Odier Investment Managers. So we couldn't think of a better person to talk about how to invest in smaller companies in the midst of Brexit. For those of you who don't know, Lombard Odier, which was established in 1796, is the oldest private bank in Geneva, and one of the largest in Switzerland and Europe. With a network of 26 offices, it offers its clients a wide range of financial advisory services. This year, Lombard Odier is our impact partner as well. Adam, we're delighted to have you here with us today. Before we get started, I just wanted to remind everyone that there will be a question period at the end. So feel free to drop your questions in the chat as we go through, and we'll address them after the presentation. So Adam, I'm turning the presentation over to you now.
Thank you, Sebastian and Deborah. Very grateful for the opportunity to participate in the MIPC series. As you can imagine, this is a subject matter that is very close to my heart, very close to our daily life, our daily job. And I have to say, a fascinating time and a brilliant choice of competition subject. For reasons of both Brexit and COVID, the concept of a British National Strategic Wealth Fund is not, in fact, a fictional one. I have been investing in UK smaller companies for more than 2 decades. I'm responsible for managing, or a team that manages 1.2 billion, dedicated exclusively to publicly listed smaller companies. And that would probably make us the largest investor in smaller companies with a market cap of less than $1 billion in the UK. I'm also chair of the Quoted Companies Alliance, and the QCA is a non-for-profit membership organisation which represents smaller companies, self-charged with making sure our ecosystem remains well configured, so that those companies have access to capital. So in that context, and back to your challenge, I can say 2 things. And those 2 things I can say firsthand. This is a very real and very live debate. Right now, there are a number of very different stakeholders, including but not limited to government, who are looking at the establishment of recovery funds to invest and support the UK. They are wrestling with the very questions you've asked: the investment targets, regions and sectors, investment return, the massive question, corporate purpose, and with that, investment impact. So there is no question that your subject matter is brilliantly contemporary and live. Secondly, clearly, COVID has expanded inequity and inequality and increased the sense of urgency. And what we have seen in the last 6 months, for example, is that more than 13 billion sterling has been raised on the UK equity market, and north of 2 billion has been raised by smaller companies at speed, in haste. Obviously, some of that has been defensive, to provide liquidity and financial support to companies, particularly that have been struggling for obvious reasons, for instance, in leisure and retail and travel sectors. But it's also been for companies that have seen COVID accelerate trends, whether that's benefiting from work from home, digital requirements online, or even with solutions or nascent solutions to the disease itself. So quite frankly, the question you ask, I think, will in fact become a reality within the next 18 months. And if you'll indulge me, dare I say these moments are rare. To this day, I can recall a moment on November the 9th in 1989, I'm showing my age now, as a 19-year-old student sat in a lecture hall in the Schofield building at Loughborough University as an undergraduate. It was the second year of my undergraduate degree. It was a course, the particular module I was studying was in German politics. And Professor Stephen Paget walked in and very melodramatically picked up the course syllabus, ripped it in half and threw it on the floor. Overnight, the Berlin Wall had been breached. And everything we were studying on that course in a moment had been consigned to history. Yes, we were talking about a wall coming down, not a wall being built. In that moment, the political, social, and monetary landscape in Europe was being rewritten. These sounded to me, as a 19-year-old, outlandish statements. I couldn't quite get my head round a 50-something-year-old professor getting very excited in what was ordinarily, typically very dour lectures. But from that moment, German unification followed. The EU altered almost overnight. Integration hastened. The membership widened, and the euro was conceived. And Britain's already challenged relationship with Europe became ever more tortured. So the point I'm making, I think, is there were a range of political, social, and economic forces then at work that shaped the trends and investment decisions that I've been making in my career for a generation. And I think we are in a similar moment today. The scale of political, economic, and social change, facilitated as well by the rapid advancement of technology and the impact of social media, you might genuinely not get a more interesting challenge in your working careers than the one posed by McGill competition in the next 3 decades. So, as I say, a brilliant choice. Back to the subject in hand. Enough of my personal history. There can be little doubt, I think, that the forces that produce Brexit are similarly the same forces that produce Trump. There are some common grounds here. There's a global context here for Brexit. And perhaps before we talk a little bit about the UK, we should talk about how do we arrive at this moment. Before putting our slides together, I did actually had a watch of Alex and Mandy's introduction to this challenge. And in normal circumstances, I would be looking for you in the audience just to acknowledge what a superb summary you've put together there of the state and the significance of inequality or inequity. At Lombard Odier, we've had similar data presented differently here. When we first joined, the team and I came across to join Lombard Odier because we felt there was something quite interesting happening here in 2017. And one of the earliest pieces of work I stumbled on was by our resident economist and strategist, Sami, who, and this is one of my favorite charts throughout my career, actually. Sami combines some very tangible measures of economic and financial inequity, but also with some intangible, softer measures of social exclusion, if you like. So, for example, the prevalence of drug abuse and crime, even the incidence of teenage pregnancy, all the kind of factors that might point to the failure to access public health care, public education, social support, and so on. And of course, all magnified by COVID. So, I mean, even if you think about kids in families of low-income families who have been in lockdown, access to laptops, iPads, PCs, the things we take for granted. These aren't unlimited resources in low-income families, and can have profound impacts to not only the immediate education outcome, but life chances. So what's interesting in Sammy's work, but also what was identified when the portfolio challenge was posed, is the two countries perhaps most exposed on measures of financial and social inequity are the US and the UK. Both, I think what we're saying here is there have been some unintended consequences of globalization. And what we're seeing is a kickback against that. Now, I probably don't need to retrace the history of globalization. That will have been done, no doubt, in McGill in university courses, and is well-trodden ground. But just a few very quick observations. That process of globalization actually, ironically, began with the Berlin Wall coming down. It enabled multinational corporations to exploit new countries, new markets globally. They were funded by the globalization of the financial system, by debt markets and monetary policy, ever cheaper debt. And with that, we saw the expansion of global supply chains and the outsourcing and offshoring that followed. The reason we arrive with these challenges today, I think, is because those spoils of that growth, that global growth, weren't shared equally. In fact, they benefited disproportionately the establishment. They benefited a corporate elite whose profits rose on the tide of that global growth and monetary support and remuneration policies attached to equities. They benefited a financial elite who slowly lost touch with the purpose of the finance function, and for whom a return it became the end in itself. And really interesting, they benefited a political elite. They allowed for an extended period of low inflation, global growth, and little incentive, I think, to change the status quo in terms of policy. So the system appeared to be working. GDP moved on, house prices rose, equity markets move up, prospects seem to be improving, but not necessarily for the regions where industries were threatened either by technological advance or cheaper alternatives of goods and supplies elsewhere. Not for a generation, and this is particularly a UK problem, not for a generation who can't get on the housing ladder. In fact, if you are less than 35 in the UK, you're actually often referred to as generation rent. And rent becomes a disproportionate amount of your financial expenditure. And not for groups whose gender, race, colour, creed locks them out of, via institutional discrimination, locks them out of the workplace or the social system, and increasingly are unable to affect change. So I think we find ourselves with these forces slowly building to a crescendo. And as ever, if politicians don't change, electors find ones that will. And empowered by adversity and unity university, those social groups have become increasingly defined and found lightning rods. So Donald Trump, and these are some stereotypes for the purpose of making a point, but Donald Trump representing the Rust Belt, Elisa Milano, when she tweets "Me Too," George Floyd is now a Black Lives Matter martyr. Greta Thunberg it genuinely is the poster child of Extinction Rebellion. So this has been, we've been in a moment where the disenfranchised have begun to kick back against the establishment. And I think that sets the context for Brexit. Brexit is, that is exactly what Brexit was for the UK. The beginning of moving those forces from global to local. Interestingly enough, the very reason we had a referendum at all was down to one giant political miscalculation and symptomatic of an establishment or an elite that wasn't listening. Now, I don't begrudge David Cameron. I think there was a Conservative Prime Minister who was going to have a problem with this issue at some point. He happened to be the one in charge at the moment. But there's a very interesting story behind why we had a referendum at all. He was not only a product of Eton and a student of politics at Oxford, but he learned there that if you present the population with radical change, in general, they always vote for the status quo. That was reinforced by when we had a referendum over here in which Trump featured with his golf course, and when we had a referendum over here on Scottish devolution. So when David Cameron put this question to the British public, he genuinely thought they would vote for the status quo, and completely underestimated the force for change that was building below. And that force for change, there were three subject matters that dominated the debate. I'm not going to dwell unduly on them. They found two lightning rods in Nigel Farage and Boris Johnson. You can see their pictures there. Kindred spirits with Donald Trump, quite literally. A larger than life. And a generational shift in the policy framework, which is the question you're addressing now. But the interesting piece in all of that is a couple of headlines. Border control and immigration dominated. Sovereignty and the democratic deficit in the EU dominated. The economy was the other matter, but it's too dry a subject. This was a conversation. This is a broader conversation about rhyme, not reason. It's about hearts, not a battle for the mind. And so we saw things like, I mean, the icon of the referendum is that battle bus, that giant red battle bus. We send the EU 350 million a week. Let's spend that on the NHS, vote leave. That was hotly contended. It's been widely recognised, even accepted. That big red bus was a big red lie. It was our own version of fake news, but it didn't matter. It captured the zeitgeist. It captured the imagination. And as it happens, where we sit today, while we were in lockdown, that graphic at the bottom it shows how we had something called Clap for Carers. Every Thursday during lockdown, people would come onto the street, stand on their doorsteps, and show their appreciation for the key workers in the health service who were on the front line. That's a complete turnaround in the esteem in which public workers and public service has been held in the UK. It matches what we saw in a slightly different way in New York with the fire service in the aftermath of 9/11. So a dramatic moment. I do think a sea change from a policy perspective, and what it's involved is a rejection of things like monetary policy. This is where I think I have to be a little bit careful, because what I don't want to do is prejudice some of the conclusions that you might reach in your challenge. But I think we've reached the end of something we call over here of austerity. A favour now in policy must now be in favour of the regions. It must be in a way that can be felt and touched in people's real lives, in communities, in local towns and villages. That means it can't be monetary, which has been an intangible transmission mechanism. So I think there are some fantastic questions for you to be thinking about in all of this, about where the target should be. Some of those have been highlighted, and there's obvious stuff to do, like green energy. I think there's a really interesting question around old and aging infrastructure, or perceived old industries. Shipbuilding in the UK it looks like it may well enjoy a renaissance, in part because of protection policies to support defence, but actually also because they're the facilities that have the capability to build renewable energy sources, wind turbines, and so on. And I think in there's another question as well to think about, which is a broader question about the balance between debt and equity. You must be careful in listening to me. I'm an equity investor, so I'm clearly biased in some of these conclusions. My view is that what the world needs right now is more equity investment, not more debt investment. There are tremendous advantages around equity investment, which include longevity. It's permanent capital. It allows companies to think long, rather than think about repayment schedules, how quickly a return needs to come back, how quickly they need to respond to private or equity leverage or debt provided by banks. So lots of things in there, I think, from a portfolio challenge to play around with on this subject matter. Alex, can we move to the next slide? So what's been actually the real impact in the UK? I mean, the UK is ripe for investment today on a number of fronts. What we saw in 2016 post that referendum was a huge hiatus in decision making. At the political level, the government has been hamstrung by very small and slim majorities. So the ability for the government to do something, not least solve the Brexit conundrum itself, has been hamstrung, but its ability to move on and invest in the economy has been hamstrung. Corporates have stepped back and looked at the UK and said, well, we want certainty before we commit. And understandably, those who look at the UK as investors also want to see what's the shape of the UK post Brexit. So it's very difficult to come up with numbers. But if we look at trend data, we can probably safely assume that the UK stagnated. We know it slipped to the bottom of the table of the OECD league tables, and it's probably been, in GDP terms, performing a good couple of % per annum below trend. So there's an accumulated pent-up investment there, which has been waiting to be released. From an equity perspective and from an investor's perspective, you can see there that from the moment of that referendum, the valuations between the UK and the rest of the world have widened. That uncertainty has meant, and there's a great presumption, we'll come to this in a moment, there's a great presumption that all UK listed companies are domestic companies and carry a higher risk profile. I think there's and accordingly, therefore, smaller companies in the UK have gotten cheaper versus the broader market. I think actually there's a bigger thing at work there, where investors with lots of macro things to worry about are preferring to have the freedom and the greater liquidity to change their mind and invest in larger companies. So heading into this, and the data on the bottom of this slide, you should be wary of is pre-COVID data, obviously, because the earnings numbers are somewhat flexible at the moment. So in the UK, a discount for being UK listed, a discount for having a domestic focus, and a discount for being smaller. As you might well expect, Alex, you want to move to the next slide? I think there is a wonderful paradox here. What is little appreciated about the UK equity market is that it is the largest smaller company equity market, and almost single-handedly the only equity market, if you're a smaller company, you can go to outside the US in order to access capital. As a consequence, it's rich, diverse, It's as much international as it is domestic, and there's lots of demographic data there for you to consider. The most exciting bit for me is the chart I draw your attention to in the top right of this pack. And that is, it's constantly refreshing. It's an opportunity set. It's not really an asset class. In normal circumstances, we're looking at a world where there are up to 1,400 companies listed in the UK with market caps of less than $1 billion. It's a constant refreshing set, as in we will lose 50 to 100 every year, and an equivalent number join. And they will leave through the combination of failure. It's a good thing. We shouldn't forget that. Fed up, the public market's not working for them, and corporate takeover because they provided solutions for larger companies and they have been taking advantage of from a valuation perspective. Equally, we see a similar number of companies join in normal years, and that means what I can say with some confidence is the universe I look at today could be 30, maybe 50% different in its color, character, and hue in 3 to 5 years. So it's constantly adapting and refreshing, as I say. And the smaller company paradox from a listed perspective is clearly when we look at where the greatest challenge is, the political, economic, and social and technological change opposed are for larger companies, and it's the smaller companies that are the most adaptive and best able, and this ecosystem best able to provide investment that solves some of the very challenges, I think solves some of the very challenges your competition poses. Next slide, Alex. So just to finish off and bring this to life a little bit, and a little shameless promotion, if you pardon. These are a handful of our core positions as we speak today. In the policy changes that are around, we have a position in a business called Sigma Capital. It provides dedicated private rented housing. It builds and provides dedicated private rented housing for low-income families. It's an area which has been massively underserved by the traditional house builders in the UK and is receiving a significant amount of government funding direct today. In terms of impact investing, we have been long-standing shareholders and a fan of CareTech, which provides mental health care services and disability services for children and adults in the UK, and particularly on the mental health care side, clearly in the environment we sit with COVID, a source of growing need. On the technology side, BATM is a play on both the emergence of 5G mobile technologies, but also has delivered 3 COVID tests to market from its medical diagnostics business this year. And if you're looking at economic recovery, there are companies like Reddy Northgate, famously known for its white vans, as you can see there, which are the engine of the UK economy. So much so that politicians target white van man as part of their voting, as part of their electoral strategies. So hopefully that gives you a little insight on the world in which we live. Hopefully a little insight on the context for your competition, which, as I say, is brilliantly conceived, and I wish you well in addressing that challenge. Do we have any questions?
Yeah, thank you very much, Adam. That was very insightful. So I believe now we can pass on to the Q&A session. So first question coming in asks if UK small caps and micro caps are running a higher risk than large caps of shutting down as the result of the confinement policies due to COVID.
In public markets, you're always going to get casualties. I think you'll find, as a consequence, you'll find individually, you may find in number more casualties. But it's a bit like the credit crisis. The credit crisis, smaller companies were seen as a problem in a risky area. And actually, the source of the problem, the biggest challenge is the companies that needed the greatest recapitalization were the banking and financial institutions in the FTSE 100. I think there are some much bigger challenges post of the larger companies. They tend to be giant behemoths, which tankers you can't turn quickly, whether that's a Royal Dutch Shell, a BP, challenged by much greater structural trends that are out there. So the shorter term stuff about COVID, I worry less about in that respect. There will be casualties, but the risk profile in terms of outcome is disproportionately favourable for smaller companies, in my view.
Perfect. Another question asks, what broad risk factors do you consider for investing in the UK small caps? How do you manage risk between private and public investments in domestic companies?
So the most important thing is patient capital. We have to make sure that there is a match between our investor expectations and the likely time frame on which we can see outcomes operationally, which hopefully deliver in terms of share prices on behalf of investors and shareholders. There's an important distinction. We don't do private, we only do public. So it's not illiquid, but it is less liquid. Hence, patience of capital, longevity of capital, investing in this space is the most important risk factor to take care of.
Good. So next question asks if in this period of high uncertainty, is it preferable to be diversified across a wide range of sectors or to specialize in a subset of more robust sectors?
We take a very stock-specific approach to this. I think there are sectors right now which are more difficult, but within those sectors, what I think the way to address that risk is to look at who wins. I think in these big cycles when they turn, sometimes we get very anchored as an investor trying to predict what happens to an industry in aggregate, what's trying to happen to revenue, what happens to revenue and profit individually. Qualitatively, I think it's much easier to identify who wins, and very often it's much easier to predict market share gain than it is to predict a market. So if you've got sensible investment horizons and you take that approach, you can take a more diversified approach. You can invest when others are risk averse, and obviously that's where you'd hope to make a greater return. But if you can tie that with patient capital, I'd be looking to identify those who win. What I would say is I think there's a really interesting opportunity right now. There's a big debate between value and growth, and so a lot of sectors get lumped in the value bucket, and a lot of companies within those sectors get lumped in the value bucket and disregarded by many investors, even though they have growth prospects. They just carry the wrong label. So I would be hunting for those kind of hunting in unloved sectors for companies that have growth and have the ability to change and use a lot of the technology that people get very excited about, particularly in the higher echelons, the S&P and NASDAQ and so on.
Perfect, thank you. So next, what do you think are the potential catalysts for the valuation gap between the UK and other markets to reduce? What is your sense of timing for those catalysts?
Certainty. It's the one question I can be unusually brief on. If I look at the world today, I think there are three uncertainties out there. One which will be resolved subject to whether it's contested or not. It should be resolved in the next 48 hours or so, which is the US election. The other is Brexit. We don't think there is a disaster around the corner on Brexit. And actually, as I suggested earlier, it's the certainty of an outcome rather than the detail of an outcome that matters. And I think that opens up the investment case for the UK. We saw a real acceleration at the back end of 2019, the beginning of 2020, pre-COVID. We saw a real acceleration in GDP, in consumer and corporate activity levels, in investor appetites, and in the UK stock market, on the back of the large margin secured by the current Conservative government. It meant we had certainty of political policy direction for the next 5 years, including to a degree, around Brexit. So I think certainty is the big question. The outlier here right now is COVID is the intangible, which is more difficult to price. What I would say, and I always default to though, is there is never a good time to invest in smaller companies. There is always a reason not to, from a risk perspective. And it's slightly be careful what I wish for at this end. I love that. We love that as a team because it means the potential of a lot of these investments we look at goes properly undiscovered.
Thank you. So next question. Do you foresee the UK economy to fundamentally change post-Brexit in a way that even the most certain sectors of small caps are at risk of failing?
I think the simple answer to that is COVID, Brexit are actually, in terms of change and structural change, inextricably tied at the hip. What we've already seen is trends that were already in place being accelerated. We could go through sector by sector, but the one that everyone is most familiar with is something like the retail market. We have begun to find out what omni-channel genuinely means, and is clearly those companies that's route to market is entirely online or digital have done very, very well. But there are a range of companies that are really well balanced are finding out what the optimum size might be of their retail estate. There are those that haven't made their move that face some real challenges. And I think we can go through sector by sector and identify the prospect for failure in terms of the structural change that is already in place. The new parts of that equation would be clearly things like what does work from home do, what does a more typically remote working environment do, and require in terms of support for corporates in general.
Excellent. So the next question asks about the relationship between small caps and private equity. More specifically, is it meaningful to train talent in small caps with a view to building skill set for private equity, or vice versa?
Sorry, Deborah, can you just repeat the question? I didn't quite catch the beginning.
Sorry about that. So is it meaningful to train talent in small cap with a view to build skill sets for private assets, or vice versa?
In general, private assets tend to trade at a premium to smaller assets, though they also carry less liquidity or near zero liquidity and higher debt. There is an assumption behind that around control. There's an assumption behind that control that you are more engaged, more active operationally. You tend to have one shareholder, not many. So it's a different type of accountability. So in general, I think personally, I think there's an illusion of control within that. But in general, what I think you find is the skills, what we've benefited from, and what becomes increasingly improvement is taking some of those private equity skills and engaging actively with companies to help them with their strategic development, the messaging of their story, and the progress operationally.
Excellent, thank you. So next question. Christine Lagarde recently said that we now have a unique window of opportunity to reshape the economy in order to become more sustainable. What are the implications for small cap investing in the UK?
Rich and wide. There's an interesting and inconvenient truth which we've been doing some work on, which is, as it happens, after NASDAQ and the S&P, I think, and I might need to check the data to be precise on this, I think the AIM market in the UK is probably the best performing equity class modern modern developed economies. And the reason of that is I go back full circle to what the characteristic is of the smaller company market. If you were to look at the UK market as a whole, you will find that large is short of technology and long of banks, insurance companies, energy companies, commodity companies, etc. If you look at the makeup of the smaller company market, the further down the market cap spectrum you go, the closer you get in terms of shape and exposure to the sectors of the S&P, funnily enough. Obviously not with the scale, obviously not with the valuation, and obviously not with the coverage. And as I say, I think there is, and we're already beginning to see the IPOs surface, which bring new opportunities in new sectors to market. This space is very good at adapting. And so I think this is a great place to hunt in terms of trying to invest in companies that benefit from the scale of change we're seeing across a range of sectors.
Excellent. Next, is it challenging to benchmark small cap? Could allocators be missing the dynamics of the opportunity by starting with passive indices? Brilliant
question. Absolutely spot on. There is no natural benchmark in the UK for investing in smaller companies. And given the liquidity structure of a longer tail, you can't passively benchmark or invest in them. This is an active market. The way I would rephrase the question is, let me do a moment around the structure of the UK market. At the bottom end, you've got companies in a fledgling index, typically less than 100 million in market cap. You've got above that AIM companies that go anything from 10 to 3 billion. The small cap index, which is FTSE listed, listed names, is about 170 names, typically between say 100 and 300 and 400 in market cap. And then the FTSE 250, the largest 250 companies outside the FTSE 100, which is typically 600 up to several billion, say 4 or 5 billion. So the structure of that equity market means, and the size of that equity market means, the only derivative you really have passively that you can invest in is a FTSE 250 derivative. And therefore, the real question is not to think about this as an asset allocation space to be benchmarked against, but rather to see it as an opportunity set where there is a scope to make an absolute return, and to do so and commit capital patiently over time. That's where this space fits slightly differently. It has to fit slightly differently into investors' minds than conventional equity investing.
Absolutely. Thank you. That's very insightful. We can conclude with a broader question, perhaps. Which investor has had the greatest impact on you?
Oh, what a question. It's a chap called James O'Loughlin, Jim, who was my mentor when I first started in this game. I came to the industry quite late. I didn't start investing until professionally, that is, until I was 28, 29. And Jim and his partner in crime, Dave, gave me a job in at the Co-op Insurance Society, as it was then. Jim was an early adopter of behavioral finance principles applied to the financial game, and in fact wrote a book called The Real Warren Buffett, which wasn't really about Buffett. It was really about Charlie Munger, and it was really about the mental models that they deployed. So not about being clever in your modeling, not about being clever in terms of doing more work than everybody else, but being clever in understanding the right questions to ask at the right time. And in fact, a lot of the precursor to what we see data trying to do for us today, get back to the stuff that actually matters and have frameworks for making decisions. So Jim knows this. I owe him an enormous debt of gratitude. He got me to a place in this game much earlier than I might have done on my own.
Excellent. So I guess that's it for today. I wanted to thank you, Adam, for coming here today and for sharing your knowledge with us. And also thank you to the audience for being here. And I hope I will be seeing you soon at the other MIPC events. Have a good day, everyone.
Brilliant. Thank you for your time.
Thank you. Bye.